Hello and welcome everyone to another weekly update of the margin account. In this video, I'll be going over the margin account position as of August 7, 2026. The first week of August has definitely been a good one. In fact, it was so bullish last week that the overall total return of the portfolio is back to positive. However, it was not a positive week for all ETFs. UTS in particular experienced a good amount of bearishness, and I could not resist the urge to buy some more of its units as its share price went down below $9. Also, we received $233 of income, which helped in boosting the overall total return. The expected future yield of the portfolio has dropped slightly below 40%, which I will discuss in more detail when we take a look at the portfolio later on in the video. But first, let us take a look at the ETF I purchased last week. In total, I bought 170 units of UTS for an average cost of approximately $8.75, which cost me almost $1,500. To make this purchase, I invested a capital of $1,000. This represents a margin multiple of 1.5x. Since UTS only has a 30% margin requirement on Wealthsimple, I think 1.5x is a fairly safe margin multiple to use. I also want to highlight how this purchase has helped me reduce the average cost price for this ETF in the portfolio. Previously, I held 70 units for an average of $9.68, but with this purchase, I now have 240 units for an average of $9.02. That is almost a 7% reduction in the average cost. If we look at the historical trading level of UTS, the lowest it has gone is around the $8.70 range. So I doubt if it will go too far below where it is right now. If it does, I will probably buy more. This is how I personally prefer to do the dollar cost average. If a stock or ETF is trading at a price which I feel is high, I will take a small starter position in it. This way, I'm making sure I have some exposure to the particular equity if its value keeps going up, while at the same time giving myself the ability to buy a bigger chunk if its value goes down. Now let us take a look at the income we received. The table on the screen shows all the ETFs that paid out last week. I've also put a green tick mark next to them confirming that we have received all the income expected for the month of August. The remaining ETFs should pay out by August 10th. The ones highlighted in yellow are those that pay their income semi-monthly. In total, we received $233.34. In addition to the capital appreciation we received last week, this income definitely helped boost the total return of the portfolio. So let us take a look at how the portfolio looks now. This is the portfolio as of the end of day on August 7th. We can see that there is a massive improvement both in terms of capital return and total return. If we look at last week, we were down almost 12% in terms of capital return and 7.79% in terms of total return. This week, however, we are down only a little over 2% in terms of capital return, and in terms of total return, we are up 3.05%. This improvement mainly comes from the overall improvement in the capital value of the portfolio. If we look at the capital gain loss column last week, we were down $1,500, but now we are only down $295. And in addition, we received the income of $233, bringing the total income paid out from $488 last week to $721 now. So this explains why we had an almost 10% swing in terms of total return. We went from being down over 7% to now being up 3%. This is in line with the overall market being bullish over the past week. All of this looks great. The only thing that does not look great is the yield on capital, which is now 39.93%. Ever since I started this account, this is the first time the yield on capital has gone down below 40%. The simple reason for this is that I bought the UTS ETF, which pays around 18% yield. Even after using the 1.5x margin, the yield on capital would be around 27% for the added shares, which brings down the overall yield of the portfolio. If we look at the previous week, prior to this purchase, the yield on capital was 40.83%. So we were already on the threshold of that 40% mark, and this purchase pushed us below that threshold. If we dig a little deeper, however, there were also recent reductions in the income payouts from AEME, YTSL, and MSTE. All these factors have contributed to reducing the expected yield on capital below 40%. Obviously, if I buy more units of Big E or HHIS next week, it will shoot back up above 40%. Similarly, if any of the ETFs increase their payout, it will go above 40% without me needing to buy any more ETFs. The point I'm trying to make is that at the end of the day, despite my best efforts, it may not be possible to keep the number above 40%. Hence, I'm not going to hyper focus on that moving forward. The 5 ETFs I highlighted in my previous videos, Piggy, HHIS, CDAY, SDAY, and QDAY, remain my focus as core holdings. But every now and then, if I come across something that I feel is undervalued, I will buy it even if it reduces the overall yield on capital. On that note, we come to the end of this video. Let me know if there are any specific ETFs you would like to see being added in this portfolio. Thanks for watching. I will see you all in the next one.